What if AI allows us to build at a fraction of the cost? These 3D printing homes or something like that. So if there's a change in the technology or the cost structure, that could radically change the value of all real estate.
How much are you paying into like market surveys and things like that? And the person was saying, I don't actually spend any money. I just go and look at what Starbucks is buying, where Starbucks is opening new locations, and if I'm within a 5-mile radius, I'm gonna be good.
I see so many of these products are just Me Too's. They're no different. I'm just copying what this guy's doing, and I think I can do it for less. That's a race to the bottom. If you don't have incredible vertical stack of integration, like this is why we're different. This is what makes us special. This is our secret sauce that can't be replicated and copied away by ChatGPT or some other Claude, then your days are numbered, and you're building your business around this, your livelihood. Stop.
And they were so humble to the point of like, they were hired by a university, and the university's like, tell us the answer. He's like, we don't know. But we're going to ask a heck of a lot of questions, and we're going to make a heck of a lot of mistakes.
Do you have a training, onboarding video for it? Yeah, we do this. How long does it take? It's going to take this long. Did you ever see a training video for Uber? They're like, no, because it doesn't exist.
And then they think rent control, and it's never worked. It's never worked. Could you imagine being a guy that bought a bunch of that stuff in New York City, and now you're stuck with it, and you can't raise your rents? They totally changed the law, and you're stuck. I did deals in New York many, many years ago, and I was blown away at how difficult it was to even...
So yeah, thanks for joining us here in Atlanta. I think, diving into the current state of Atlanta, you've got a great perspective. But what are you seeing happening right now? Are you seeing too much supply, the right amount of supply, enough development? What's your take?
This is an interesting thing. We're starting to see a lot more activity. You saw Cortland just did a huge purchase. We saw Equity Residential just buy a big purchase. So there's definitely been a lot of transactions happening in the marketplace. And I think the issue I see is that real estate is relative.
Yep.
It really depends on the eye of the beholder. So what's your cost of capital? What's your return metrics? What are you looking for? And I think that if the deal fits your wheelhouse, your requirements, there's probably deals out there for you. But right now, for people like me, private investors, syndicators, it's very difficult for us to underwrite deals that work. We're negative leverage. I look at a lot of deals, and most of them do not work.
Yeah.
And that's what I'm seeing in the marketplace. So for us, it's a time to be patient and continue to watch, continue to underwrite deals, but we're not seeing the opportunities like we used to. And we don't even look at IRR. That's to us, that's bullshit. What we look at is cash on cash. Because cash on cash for us is we can solve for that. We can use realistic assumptions and say, hey, this is where we're going to get to. And we usually look at year 2 or 3. Now, usually we like to see unstabilized deals, distressed deals is really what we look for. And we're not seeing a tremendous amount of that hitting the market because of the whole extend and pretend that's going on.
So it's funny you say that because, I'm hearing a mixed bag, and it varies on who you are. And I know of a deal right now I'm actually going to come in on that's a distressed asset south of Atlanta, a few hundred units. And you're right, over 100 and something units are completely wide open. You're right, it's going to take at least probably a year to get that property up to the right level. What about the people who have said, I heard someone you probably know, we all know here in Atlanta have said, there's no such thing as value add. You probably know who I'm talking about.
Yeah.
Do you believe that there is, or do you believe that that's kind of made up? What's your take?
I think it depends.
Okay.
And the reason I say it depends, a lot of the deals have been renovated and have been upgraded. And a lot of the deals, you see this, they'll do upgraded countertops, they'll do updated kitchens and bathrooms, new appliances, new flooring, and then you'll see this gap between you and the competitors. And some of the property management companies, what they would do is they would do 10 or 20% of the units and then leave that upside for the next operator to come in and do the rest of them and try to push that up. And we've seen now most of the deals have gone through this cycle. So when you look online at the deals, everybody's units look the same. The granite countertops or the stainless steel appliances and that type of stuff. So we're all pushing the same product out there. But there are examples where value add is still out there. And I'll give you a great example of this. We just purchased a deal in June in Johnson City. It's a 576 bed student housing deal. And the biggest thing about that deal was we are taking that deal. The competitor across the street is an older property, and we're 2014. And it's been mismanaged in such a bad way. and it needs substantial renovation. So we're going to substantially renovate it, and we're going to be able to increase the rents by about $117 a unit.
Wow.
So that's an example of a value add. We're going in and adding value to the asset. So I think it really depends. And this is an interesting thing. I think I came up with this framework that helps me whenever I'm looking at real estate, and I call it stacks. So it used to be location. That was what everybody said. Well, the stacks is very simple. Site, that is your location. The next one is T, timing. Where are we at in the market? Where are the cap rates? Where's the leverage? Okay. The next one is assets, all in. What's our all in price? Okay, all in price. So you don't want to be paying double what someone else can buy something for. What are the relative comps? C is your capital stack. What's your leverage? What's your loan terms? Do you have 12 months to execute? Do you have 2 years? Do you have an extension? These types of things really matter. K is know-how. Do you actually know what to do? Renovation-wise, property management-wise. And then the S is the most critical one. Is what's your strategy? So are you looking to, are you a REIT? Are you an actual 1031? You're going to value it totally different than someone who's a syndicator. So when we look at it through that framework, we all value real estate differently. So to the individual, to them, that's probably correct because of how they look at it. And I guarantee you, I look at a lot of deals, and he's absolutely right. The majority of the deals, there is no value add.
Mm-hmm.
Absolutely. So
the previous person should have done it.
Yeah,
right?
that's right. Yeah.
If it was there, why didn't they do it?
Yeah.
I mean, you see this all the time, Adrian, when you're going to properties. But I think when there is something, I think there's always a story to be told. If someone has done such a horrible job, where the pool has been closed, the playground is non-existent.
That's right.
The parking lots are in disrepair. People are fed up in the reviews. That's probably a huge opportunity, right?
That's right.
Back to what you were saying, it's in the eye of the beholder. You just wrote, basically, while I was preparing for a conversation, I took 6 or 7 of your posts, and I read them, I studied them, and I want to ask questions, specific questions related to those. You mentioned about a deal that just closed here in Atlanta for 69 mil, and then you did underwriting on a deal. You could barely stretch it, evaluated at 59, but it closed for $10 million more. I like for you to kind of like share with us how do you explain that. You also have a theory with the sharks that in order to leave they had to like move. So I want to get into the shark situation, and in this particular situation, what could have made that group like pay $10 million more than you were willing to pay?
Well, again, back to the whole eye of the beholder. Definitely, from their perspective, they could have lower cost of capital. They could be a 1031. They could have more optimistic rent assumptions, saying, hey, it's not. Ken's looking and seeing 2 months free rent in the market. They may say, well, that's only temporary, and we're going to jack the rents 8%. We're going to go in and do additional value add. So you have to tell yourself something when you're looking at the performance, because there's only a handful of levers we can pull. We can pull the actual rent growth lever. We can pull the occupancy lever to get the occupancy higher if it's not stabilized. We can reduce operating expenses somehow, some way. So maybe we're going to make a more energy efficient system. We're going to add water retrofits or something like that, reduce the water cost or other types. We can, maybe our insurance gives us a huge competitive advantage. I don't know about you, but insurance for us has gone up 80 to 100% from when I was underwriting deals. Just in the last couple of years, insurance has gone crazy. And you pay way more for way less insurance. So it's wild what's going on with insurance. Those individuals, they may be smarter than me as well. That's also a possibility. But I think maybe from their perspective, it worked, obviously, because they did the deal and they raised the money.
Back to the insurance part, because this is like a huge topic of conversation throughout the industry. Everybody has similar concerns with yours. Are you seeing any ways in which you as an owner could insure at a better rate than, I'll say, most of the companies out there? Are you seeing any creative ways in which maybe your insurance cost, your premiums will go down in a current market, current situation?
The lowest rates I've seen are by the large groups, because when you have an aggregate portfolio, you can then spread the risk out and you can take larger risk deductibles. You have to structure it in such a way that the mortgage lenders will allow you to do it. But that's where I see the biggest savings is definitely when you have large size and you can aggregate it and get some sort of savings that way. Individually, I see like the wind insurance. That's Swiss cheese for a lot of damage. You look at what happens in Florida and it's like 5% deductibles and different crazy things in addition to, it's just wild how little the insurance actually covers. And a lot of times they don't have any water intrusion. There's all these different exclusions that are not included. Dog biting. Well, if someone gets a dog bite, that's excluded from your liability. What? You got to read the fine print. So you see that and you're like, I can't believe that's not covered. You would think it would be, and it used to be, but now they're making all these exclusions. So you really have to check it and make sure that you have the proper insurance.
It sounds like we should probably start an insurance company right about now. There's always an opportunity somewhere, right? And I think with technology, right, whether it's the insurance tech, obviously there's a lot of fraud out there too.
That's right.
And I know that there was a whole discussion around Florida and more on the HOA side of fraud now. But it sounds like also things move. There's cycles, and you've obviously seen a few. Is there, if we talked about Atlanta earlier, but if you think about certain pockets, I'd love to hear maybe a couple of the secrets that you're seeing right now that maybe some specific neighborhoods, because I think, as you said, the eye of the beholder can also apply to this side of the street, that side of the street, this type of asset. Are there certain pockets that you're seeing that stand out to you right now where you're like, actually, Tampa is great, or Jacksonville, or Columbia, Savannah, any of these sub-markets that you think are a good opportunity?
I wish I could say yes, because I would definitely be buying there. Unfortunately, we underwrite every deal that comes out. And if it doesn't meet our criteria, we have a weed whacker. We call it our weed whacker. And we do an initial underwriting, and very few deals actually get to the higher level of underwriting where we actually do deeper. And I would like to say this particular market is better than that. But I will say that I'm just not seeing a lot of deals that pencil for a private operator. Obviously, it's working for the large companies. I think Cortland paid like $575, I think is what I saw in the article, for those deals, which with their cost of capital is probably a great return for them.
For Elm out in DC?
Yeah, that's right. Yeah.
And obviously, there's a few more deals that we just found out about this week. We won't say publicly because I think they're still, we'll let them announce them. But is that because of blood in the water, and then it's making it, coming? They were trying to sell, didn't happen, so now it was a forced sell, and people finally got those numbers together, like you're saying. Is that the idea, or do you think there's more to it?
I think that is happening because we just got another deal that came out. I won't mention the name of it, but they're willing to sell at their loan cost. And I'm seeing several deals like that hit the street where they basically, they're wiped, their equity's gone. They put a lot of money into it, and and of course when we look at when we're looking at the deal and saying, wait a minute, we can't assume that existing with that rate and that debt, that leverage, it won't work for us, and you need a lot more money, so we don't want to step into your shoes. We're not going to rescue you. So I think it's going to have to be foreclosed on, and then it's going to take time for it to work its way through the market.
Interesting. On the point around technology, because we love to dive into that. Is there anything interesting you're seeing in the insurance tech space? Or do you think, I always say, we've had people on who sometimes say, oh, that'll never change. It's too hard to change to be affected. And others will say that's actually, when someone says that, there's a great opportunity there. So do you think that technology can solve for insurance tech? Can they solve for fraud? Or do you think there needs to be more government regulation? What is it that needs to happen?
Rarely do I say more government regulation, but I'll say this. I do believe what I see, and I've been on the general contracting side for a while, I was amazed when I first got into the business. There are two separate sets of books. One book is for what your general cost construction is, and then there's another one for insurance. So why would a 2x4 cost double for a fire building versus, it's crazy, the cost estimates and what we're seeing, the differentials. And when you have a fire damage on your property, the contractors that come out, and how the difference between them and your contractors, the pricing, is insane. And they create very detailed scopes, and you have the adjusters and all this stuff. I think there's a tremendous opportunity for AI to make it much more transparent and not to have these dual standards. A 2x4 should cost a 2x4. I understand if you have to treat for smoke damage and other things like that, but if you're replacing it, it shouldn't cost me any more on a fire job to replace it than not. And the other thing I see is the change in scopes. So, for example, when you have a building burned down and you did not have granite, and then you go back in and you try to put granite in on the upgraded units, of course, they're going to tag you. But when you're doing this, sometimes what the contractors will do is they'll throw that in and then they'll change the way the actual scope was written. So I see a lot of play back and forth with the differential in cost and the rebuilding and the cost. Now, I think fraud is another great area where you could totally have the AI help the insurance companies have a better understanding of fraud and risk, and that's, I think, a great opportunity as well. But I definitely see the reconstruction cost, and that could be something that AI could really attack.
It's time gate entry systems were reimagined. Tired of dealing with clickers, key fobs, broken call boxes, and keypads everyone has the code to? Imagine managing multiple properties and realizing your keys are miles away. With Gatewise, access is in your pocket. No codes, no hassle. Residents can let in guests or deliveries from anywhere with a single tap. Gatewise integrates with your property management system, automatically revoking access when residents move out. The Gatewise Management Portal makes it easy to control every access point remotely from any device. No dedicated computer required, just smart, flexible control at your fingertips. Gatewise also supports self-storage, giving your team cloud-based control over tenant access. Fast, secure, and fully remote. More convenience for your residents, more time and cost savings for your team.
When it comes to new developments, Ken, I heard this one, I think it was on a podcast. Someone was talking about what are you looking for when you're buying the land to develop new stuff? How much are you paying into like market surveys and things like that? And the person was saying, I don't actually spend any money. I just go and look at what Starbucks is buying, where Starbucks is opening new locations, and if I'm within a 5-mile radius, I'm gonna be good. That's a survey that's already been paid for. It's pretty accurate. You know, if we're looking at the success that Starbucks has, and we're just looking at area, and we're gonna be fine if we're within 5 miles of a Starbucks. So I love your thoughts on that, and then I'm gonna have a second question regarding something very similar. But
okay.
First, your thoughts on this.
I have a funny take on that because we actually used that as a justification for a deal we bought in Augusta. It was very close to a Starbucks, and we were very excited about it. Starbucks is right next to it. How could it be bad? But it was across the railroad tracks, and it made all the difference, and it was a terrible deal. So just because a Starbucks is close to you, the customer base for that Starbucks, depending on where that line is, could be very different. So you have to be very careful. But I do agree, Starbucks does a great job, and so do a lot of the other retailers, in trying to find that out. But of course, there's no replacement for doing your own homework, and of course, we should have known better.
Second question, in a same area, right? Home builders now are selling low and they're buying land. And this is also inspired by a post of yours. Apparently, they're buying land and they're waiting for when the market comes back up. This is where we're gonna see the new development. So, if we were to map out where the most recent purchases were made, I think can we look at it and say 3-5 years from now, this is gonna be an area where tremendous growth, and we could maybe build a business around this, or like buy more land and do like a competitor property right next to them.
Yeah, you're talking about land banking, and it's a big business, and it's something that's been going on for a long time. And they definitely look at major road developments, major initiatives, where the retailers are going, and they look at it and they buy land around those areas, and they're buying in the path of development. And it can be a very lucrative process. The thing is, if you run into a recession, your timetable of how long it takes you to get there. Most of them don't use debt, they use all cash, which of course drops your IRR, but your risk factors are very low when you do something like that. And the article I wrote about was definitely talking about the land banking, because they didn't want to be sitting on the books with that land, because if they have to mark down the land, if we do go into a recession, it could be a huge loss for the land, the actual builder. So they'd rather have a preset deal with these land banks to sell it to them in the future. And they raise private capital, and they structure it that way. So it's a great way to do it. And there are a lot of people who made a lot of money speculating in land as the development comes to them. Absolutely.
That reminds me of a book called, my grandfather was a developer in California.
Okay.
And do you remember the book, The Octopus?
No.
About the railroads?
No.
So the story goes in very much like this, where as you're talking about, the railroads would buy up land around the farmers.
Okay.
And then they would lay their track down, and basically, if they wanted that farmer's land, they would basically build the track and buy all the land around them.
Okay.
And they knew it would appreciate in value or squeeze them out.
That's right.
I'm curious on your take. As you're talking about land, land development. Obviously there's less and less land. How are you analyzing those deals? Are you using a lot more AI to look at these land deals, to look at more properties, or are you still doing a lot of it in the Excel sheets and with the Excel junkies, as they say?
No, I use AI every day, constantly, and it does do a huge. I'll give you an example. We were looking at a deal in Washington, D.C., and it got brought to us, and it was a pending development deal with one of those Amazon deals near a Whole Foods, and it was supposed to be a great location and all this. And the first thing I did was drop it into Gemini, deep research, and I created a very detailed prompt, and it immediately spit out all the issues with the board that they were trying to get approval from, and they could not get approval from, and they were delayed again and again, and they've had multiple issues. So the price started at $75 million, then they came back at $65 million, then they said they sell it at $55 million, then it was $50 million. The price just kept going down. And the more they did that, the more it made me go, well, what's wrong with it? And of course, the AI told me what was wrong with it and what their issues were, and they were in a really bad situation. So that's a great example, and I do use AI all the time. I think it's a game changer for your due diligence, but you do have to trust but verify. I like to make sure it cites its sources and drill down to make sure they're there. I've actually seen it make up fake resources that are not even there. You click on the link and it's not even there.
It'll be mixing other information.
Yeah.
I've seen this recently. I don't know if it was you and I, Adrian, but we were just looking at some stuff this week, and it was talking about a completely different company, a completely different example. And to your point, there are those unknowns, that we talk about that are sometimes uncalculated, that you could have a deal and you're like, man, this is a great deal, looks good, we're getting at a great rate, yet you don't know that something's happening on the board.
That's right.
And they're about to start having fines on that property, and these people are trying to get out before that starts happening.
Absolutely.
Or they're going to put up new regulations, or like you said, insurance.
Yes.
What are some of the biggest surprises, you think, or things that have kept you up late at night before a board meeting that could go wrong? Some kind of surprises that people maybe don't think about in their early days of syndication.
Okay, I'll give you an example. There was a property we bought in Auburn. At the time we bought the property, Auburn was one of the best markets, and it was incredible. We looked at the development pipeline. Very few deals were in the development pipeline. We're like, okay, this is great. Well, we didn't realize that there was a tremendous amount of new development all around, single-family homes, townhomes, Class A apartments, but they weren't student. But this tremendous amount being brought online, and then there was a new wave of new downtown product being built. So the entire market went from 98 to 100%. Everybody around us was 81%. And we were in a knife fight. We were 92, 93, but we paid for it with concessions and ad spend. We used to spend $300 to $400 a unit. We were spending $700, $800 a unit in marketing and advertising and incentives trying to get people into the door. So any of those of you experienced a real estate deal where you have a knife fight, that's a great example. We did the due diligence, we did the research, we did not see this pipeline coming, and we did not understand how much was being built around us. And of course, the kids and parents would just go rent a townhome or go rent something else, and it was pulling down the overall aggregate, and there wasn't enough enrollment growth to stop that. So that property and the whole submarket really suffered.
Now, I want to stay on technology for a little bit, for more than just a little bit, because I know your passion for technology, for AI, and so many things that you use AI for. One of the things that I read recently is that the AI now race is kind of like the army race back in the day. The AI companies are trying to gain supremacy and just get upper hand. All these, from ChatGPT to Claude to DeepSeek and others. And I think one of the places that they're making, obviously, computing capacity. If you're gonna develop something to work faster, better, smarter, you're gonna have that capacity. So there is such a thing as location. I'm thinking back in a day, not back in a day, even today with the stock market, there are companies that do like million trades a second, like very fast using fast computers. The physical location is important, so they locate themselves as close as possible to the stock market, so they gain over their competition. They have the upper hand. Kind of the same thing I read that happens here with the AI companies. There's like a corridor of land that's being targeted by them, buying thousands and thousands of acres to build on that particular corridor that's aligned with Washington, D.C., because apparently that's like a very good spot to have your servers in order to get the upper hand over your competition. Are you hearing about this at all? And then if that's the case, would that be a signal for huge developments coming up in that particular area right there?
That's interesting. Well, I think in order to see apartment development, we need to see jobs and population growth. Those are the two big driving things. The question I would have is how many jobs are actually being created by these data warehouses and data centers? And I'm not convinced that it's a tremendous number of jobs. It's vast areas, but maybe not that many actual physical workers. And if you don't have the physical workers, then you won't necessarily have the demand for housing. So that would be one of my concerns when I hear that. I think it's an incredible business opportunity. Of course, I wish I was in it, but I'm not. So I hear that and I'm saying, okay, well, I don't know though, build all that building, unless there's a huge number of employees coming in, why do you need to house people there? That would be my question.
Sounds like it's similar to what happened in the oil fields. up in the Dakotas. I have some friends who are in that business, and they did incredibly well. But those are people, they would set up temporary camps. It wasn't permanent housing. Number two is what's happening right now in Abilene, Texas. If you've seen with OpenAI and their new, the largest data center in the world is being built right now. And the concern is they'll have temporary jobs for the next couple of years, and then will there be enough people? We're seeing 15,000 units being absorbed in the first half of this year in Atlanta. Substantial growth, a lot of units hitting the market, and now we're hearing about development just drying up. Where, if you've got your crystal ball, where do we see Atlanta in a year from now, 2 years from now, with all the dry up of no new development or lack thereof?
Well, the first thing I'll say is I gave up predicting. So I'll give you a story. When we started QR Capital, Christian, myself, my partner, we were very confident that interest rates were going to go up. And we're like, you know what, we're going to do fixed rate debt. Everybody else was doing floating. We're like, we're not going to get caught in that. So we did almost every deal with a fixed rate debt, and we underwrote that debt as such. Well, of course, it cost us millions when we sold it in defeasance. So what I would say is I don't try to predict. I don't know what's going to happen. If we go into a recession, it could be a totally different thing. I don't know if we're going to go into a recession. Maybe we're going to have an AI boom like we've never seen in our lives before. But then if we have an AI boom, what happens to jobs? Well, we know jobs are what fuel rent growth, unless we're going to get to some universal basic income or something like that. So I would say nobody knows what's going to happen. We can all theorize. Mathematically, I would assume if the number of developments going down and the population's increasing and the job growth is continuing, then of course there'd be upward pressure on rents. And then of course that means there'd be a lot more development coming on, because as soon as the developers can see that and underwrite it, they'll try to do it. But that assumes that there's land available. And here's another wild card for you. What if AI allows us to build at a fraction of the cost? These 3D printing homes or something like that. So if there's a change in the technology or the cost structure, that could radically change the value of all real estate.
The drywall robots. You've got now the nail shooting robots, the roofing robots. You've got every robot out there. It's really interesting to see. To your point around the minimum, basic income, and then having some sort of low income housing, government housing. What's your take on government and trying to steer more, whether it's HUD or others, trying to steer more capital out there? Do you think is that a good thing? Is it a bad thing? Do you have an opinion there?
Yeah. So I've actually been involved in a couple of low-income housing tax credit deals. And the thing that amazed me is how many people were at the table getting paid large amounts of money. All these consultants, all these advisors. And it's very inefficient in terms of how the capital's allocated. The actual process, for example, I see these reports. There was something in the headline today was talking about a mixed-use affordable housing where you have low-income housing people in a high-rise with very expensive rents. And you have to ask yourself, well, who wants to live in that building? Okay, obviously, if I'm a low-income person, I want to live in that building because it's brand new and everything's nice. But if I'm paying $4,000 a unit, I don't want to be next to someone that's paying $800 a unit. So you have to ask yourself, how does that actually work out? I'm wondering. I don't know the answer to this. I do believe that it's a major issue, and I do believe it is going to take a partnership between the government and I think the tax credit, low-income housing tax credit program was a good program. I think it should be expanded, but there's huge gaps. The numbers don't work on those programs right now. They need to come up with a better way to do it. I think it's a good program. It's done a lot of good for having affordable housing, but we clearly don't have enough affordable housing. Some cities are it's really bad. And then they think rent control, like New York City and some of those, they think that'll work. Yeah,
I lived in it.
Okay, yeah. And it's never worked. It's never worked. It's just basic economics. You're going to restrict the supply because new builders aren't going to build into a rent control environment, and our current owners are not getting rewarded. If I can't increase my rents by doing capital improvements, why would I spend the money? So could you imagine being a guy that bought a bunch of that stuff in New York City and now you're stuck with it and you can't raise your rents? They've totally changed the law and you're stuck. I did deals in New York many, many years ago, and I was blown away at how difficult it was to even just calculate what the rent increases were going to be. It was like an 18-step process to figure out what the rental increases could be. You had to go step by step. You had to follow. You had to get a lawyer to look at it and verify it was right. You had to what type of capital improvement you put into the deal. It was all complicated. I was like, wow. No wonder we can't get affordable housing in New York City.
I want to get back to technology a little bit, and let's focus on PropTech that's created for multifamily.
Mm-hmm.
And I love your take, obviously as being an owner and also investor in real estate. You and I, just for full transparency, right, we're looking at LinkedIn post of someone that says with a PropTech company, they were saying we ran this test for so-and-so property management company, and in a week we save them like thousands of hours, like, so that equals to so much money. So I love your take on if someone says that, if they use that as a pitch to to get your business, what would be your reaction to that?
Bullshit. But let's just step back and look at it. I see that a lot. A lot of people say, well, it's going to save you this much time. And I'm not interested in saving time. I'm interested in saving money. So the idea would be, if you could show me that software would actually reduce my payroll headcount, then I could actually calculate the return. But if you say I simply have to run with the same number of people, but I'm paying for your service, well, then it's a cost. It's not a benefit. Now, you could say they could handle more productivity, but compared to what? And a lot of times I see these claims about this. There are three things you could do. You can either increase my revenue, you can reduce my cost, or you can reduce my headache. And if you do one of those three things and do it very well, then maybe it's worth it. But if not, then it's really not there. And they like to spout these numbers as if that's the actual savings you put in your pocket. But that's not in my cap rate formula. You know what's in my cap rate formula? The expense for your software, and I cap it at a 5.5 cap. That costs me a lot more than you realize.
The functionality of PropTech and multifamily. So you wrote a post recently, and we had conversations about this, about end user experience, right? If I put my tech in your hands and it takes you 7-8 clicks to get what you need to get, is that a good user experience? What type of product that I'm giving you, right? Is that actually making your job easier? Is it bringing you extra value, right? Mm-hmm. Is it making you more money? Or it just makes your life more miserable, and then instead of helping you as an end user, I punish you with technology. With my technology, there's a lot that's being developed out there. I like to just kind of get an overview of what you're seeing, because I know you've been testing, you've been talking to a lot of PropTech companies, trying to pitch their products on you. So a little bit of an overview of what you're seeing, and what will be the ideal product for you. And you could take something specific if you want. For example, in underwriting, probably that's like a topic in itself, because I know your take on that particular on underwriting.
Yeah. It's interesting. I think Steve Jobs had it right. You have to make the user experience very easy. I think software, a lot of people build it for all these features, all these different things it can do, but they don't think back to the actual end user. And the longer it takes you to onboard somebody, the more people you lose in the process. And if it's easy to make mistakes with your software, you're a bad designer of the software. Your software should be easy to use, it should be intuitive, and people should not have to look up a reference book or Google how to do it. You should be able to figure it out.
Uber.
Yeah, absolutely.
Uber, I keep asking people, if you think your tech is good, I'm going to give you this test. Do you have a training, onboarding video for it? Yeah, we do this. How long does it take? It's going to take this long. Did you ever see a training video for Uber? They're like, no, because it doesn't exist.
Yes.
Because they create this frictionless experience that is so, I'll say, dumb proof, that they you download the app and you don't need any manual. You just know natively how to use it. That's the type of experience that.
Love it. Absolutely.
We should, and then to the underwriting part.
I've looked at probably 25 different underwriting platforms that people are rolling out, people are working on, and I see it. And one of the things, I had a conversation the other day with somebody, and I said, you understand that everything you're doing is going to be totally obsolete next year. And he looked at me like, what do you mean? I said, you don't realize that AI agents and employees are coming? He says, what are you talking about? I said, well, I want you to think about this. If I can go to ChatGPT 6 or 7, whatever number it's going to be, and I say to it, hey, here's the package of deals, here's the rent roll, here's the underwriting. I need you to put together in my model this deal. It puts it together, and then I say, okay, what's wrong with this deal? And we talk about it. I'm having a conversation like I'm having with you right now. That's here now. That technology is here now. So you're building a product that I have to manually grab and drop something into, have to manually go back and forth with, and I have to double check it, by the way. Okay? This software is going to automatically do it. So you basically have 12 months, maybe max, before your software is totally obsolete. And I see it again and again. The software is moving so fast. These companies they're creating these things. Like, for example, meeting planners. Remember Otter AI? Everybody was about it. Now everything's got the meeting recorders. Everything's doing it. Well, that whole business model's been blown up.
Yep.
So this is coming for all this. And I told my underwriter the other day, I was talking to him, I said, you understand your job as we know it next year will not be here. You have to get really good at talking to brokers and dealing with people, because that's where it's at. It's dealing with people. This whole process of manually inputting spreadsheets and underwriting, that's behind us. I saw Shortcut AI. I wrote about this. It was amazing to watch. I dumped the package in there. I created this long prompt. And by the way, I didn't create it. The AI created it. And it did it perfectly. Now, I had to make some changes and fix stuff, but I was blown away because I was sitting there drinking my coffee, working on other stuff, and it was underwriting.
Yep.
It was underwriting. That's the future. And it's going to blow people away. And all these people that are doing this manual inputting of stuff, it's gone. It's just a matter of when. It's totally gone. And it's going to do it. Like I asked I said, do you have a system that double checks it to make sure the input's correct? And they're like, no. I said, well, if you can't even double check your own software, you can build that. He goes, yeah, I should do that. I said, yes, you should. But more importantly, step back. What's your moat? I see so many of these products are just Me Too's. They're no different. I'm just copying what this guy's doing, and I think I can do it for less. That's a race to the bottom. If you don't have incredible vertical stack of integration, like this is why we're different. This is what makes us special. This is our secret sauce that can't be replicated and copied away by ChatGPT or some other Claude. Then your days are numbered, and you're building your business around this, your livelihood. Stop.
I just listened to a call. They have the recordings with Gong or Fathom or these other companies. It was interesting because I was listening with a CEO, and I was saying, was that call, that was a pretty good call, but it was interesting, that was AI, right? I thought it was AI. It wasn't. It was actually a human.
Oh.
But I couldn't tell the difference between if it was a human or AI, because I've heard so many AI bots now doing phone calls. But it's interesting to your point, because they can help book meetings, they can help draft your emails, they can help actually do the entire process if it's properly coded. And so to your point, essentially now, and I'm seeing agents that can underwrite, agents that can help you with maintenance and other types of things, tell you, and help you reprioritize your day, like Motion AI. Amazing, these things. What do you think that means for underwriting? Will you now be able to just spit all of the work that you're all doing on every underwritten deal, and it's telling, or is it already telling you a yes, no, or what the price needs to be with the AI, or are you still having to jump in?
Okay, so what we're doing primarily with this, I have not gotten the underwriting process totally automated. I'm still using human level underwriting at this point. What we do on our due diligence process is we do due diligence. We'll run through different prompts. We'll do rent roll analyzation. We'll do different things like that. Look at the T12 and use the actual AI. But the actual process right now is still manual. And the reason, by the way, this is something recently that happened, is the data extraction was very bad. Now it's gotten almost flawless.
Okay.
So that's a limiting factor, is that. The other thing I would say is there's a give and take.
Yep.
So you have to train the AI. And by the way, I think it can be trained. So the way I would do it is I would simply take all my past deals, upload it into the AI, show it examples of good and bad, and then I would say, okay, here are the variables that we normally associate and adjust. For example, we know that most broker packages, their R&M numbers are doctored, they're window dressed, they're ridiculously low. We know that the insurance numbers need to be adjusted to our numbers. We know you have to adjust property taxes. So I use O3. Well, it was O3. Now it's ChatGPT 5. I actually used it to calculate my property taxes. And it worked everywhere very well except Washington, D.C., which, of course, is very complicated taxes. But in most places, it's very easy to calculate it. And I have a sequence of different agents I use for different things. But I believe with the new agent that's coming, it's going to use all those tools itself.
Mm-hmm.
And it's going to have a sequence, just like N8N, one of those, make.com, one of those things, but it's all going to be automated by the AI. I think Lindy AI, but this is funny, I just signed up and I started learning all this stuff about N8N and making all these things. And then Lindy AI came out, and now you just speak to it, and you don't even have to do any of that. It does all the coding for you. And I'm thinking, great, I'm glad I spent hours learning this N8N stuff. Now it's totally obsolete.
It's happening on a daily basis. It's quite fascinating what's happening out there. Ken, I want to go back in time, right? And I want you to dig into your recent or maybe distant memories and share with us the most costly mistake you ever made in real estate.
I was at a company called Miles Properties, and Miles Properties had 23,000 units. We were in 11 states. I was the chief operating officer, and we were doing beautiful high-rise condos. And we had pre-sold them. We had all this money, and I doubled down, put everything I had. Because I was making so much money, and I just thought, this is not going to end. And I believe, obviously, I didn't diversify. That's one mistake. I should have diversified, put my money into S&P 500 and just let it ride or something like that. I should have been more conservative with the investments that I made, because I didn't have to invest in all those things. And of course, I didn't have total control. I mean, Daniel Miles, who was a great CEO, but of course we got in 2008 and it blew up spectacularly. Everything went back to the lender. And you would think with all those units sold, we had deposits on all of them. We got sued by everybody. They were out there using laser meters to measure this much square footage was wrong. I think the biggest takeaway from that is nobody knows what's going to happen. And for those of you who have not been through a major recession, I'm not talking about 2022. That was no recession at all. I'm talking about a real estate recession where we see unemployment go 8, 9, 10%. When that comes, it's not if, it's when it comes. Those that haven't experienced it, they're going to realize very quickly how painful it is. And there's very little they could do. They could do everything right and still lose the deal. And it's very painful as an operator to admit that. You could be perfect and still lose every single deal you have.
Was that 08, 09?
Yeah.
Like 08, 09?
Yeah, that's right.
So timing the market is not really a thing that works, or at least for most, you would say. What are some other things that you do, since obviously it doesn't seem like this is something that you could predict, and actually from real life experience, you learn a lot from that. What are some things that you could actually do to protect your investments?
Well, number one is be realistic and honest with your underwriting. Everybody underwrites like this. There are times where it actually does this. You hope. I think reserves. I see this constantly. I've seen lots of people send me their performance wanting my advice on their particular deal. And I pull up their thing and I immediately look at it and say, wow, your closing costs are 2 to 3%. And they think that's the number. No, your closing costs are way higher than that. Where's your working capital? You need 2 to 3 months of working capital just for your property. Where's your reserves on your rehab? You only have 5% contingency? That's not enough. So I can just start looking at the numbers and I see, oh, wait a minute. You think that your capital, your R&M capital, it's $250 a unit, $350 a unit? That's a lender number. That's not a real operating number. And I see this again and again where these numbers are being put in there. These older deals require, I've seen them as high as $1,000, $2,000 a unit, depending on the asset. And you can say, oh, well, you can just upfront capitalize it. Well, good. Then upfront capitalize it and make sure you have the proper money in there to do it. So I think reserves is a big one. Having the right reserves. Being honest with your underwriting is another critical thing you can do. I think being very specific. Sometimes the best deal you do is the one you don't do. You don't need to. This is back to your comment you made earlier about the sharks. And there are a lot of companies, they have to invest because if they don't invest, they lose the right to the money or they don't have the fees to pay their overhead. They're sharks. The shark has to swim to breathe. And if your business, we don't have to do a deal. We can just sit on the hands for another 10 years if we have to. We can be patient. But if you have to do a deal, you have a large overhead and a large number of people, well, then you'll find a lot more deals than I will because you have no choice.
Very, very interesting take. Very fascinating. Where do you see the market going in the areas that you're like looking at most? Let's just say Atlanta. Where do you see the market going in 2026, 2027?
I don't make predictions.
The
Been burned there before.
I love it.
How about learning from the past? So if you think about, writings, you like to write, you like to share, and I love stories. Going back specific in time, is there someone who stands out? Maybe Sam Zell. Is there a great book you've read or something? And we had Norman Radow recently
he's
discuss,
awesome. Yeah.
and he shared the 2008, 2009, 2010 crisis where he flew up to help Lehman Brothers. I think he had a few $100 billion in assets he had to sell over the next 4 years. Was there a specific thing maybe that you dive back to that someone shared with you, maybe a mentor or a writer, and you were like, wow, that was one of the most impactful things around, to your point, around being through really tough recession or really tough cycles?
Interesting. It's a good question. I would say a couple of things that have really influenced me. One is Charlie Munger. I'm a huge Charlie Munger fan.
Yep.
And I try to read everything I can from Charlie Munger. And one of the things he says is always invert. So whenever you're faced with a problem, instead of saying, well, how do I fix it? Well, how do I make it worse? And the reason it works so well is we're all hardwired to find negative things. So if I ask you, well, how do I make sure this property fails? Well, easy. Don't answer the telephone. Let's not clean up the grounds. Let's not run any ads. Just on the checklist, you can make it. And then say, okay, are we doing all of that? Well, if we're not doing all of that, then we're guaranteeing that we're going to fail. So it's easier to flip. So the inverting of things, I think, is a very powerful thing that I learned from Charlie Munger. I love to read. I'm a huge reader. I think Founders Podcast
Yes.
is
David Sinra.
Yes,
He's the man.
He's incredible.
He's fantastic.
I listen to all his podcasts. I think I'm almost done with every one of them, and of course, I'm starting to re-listen to some of them. You can learn so much from these types of people, and they can teach you so much. And every time I listen to these guys, I always notice something very interesting. They're incredibly curious. They ask lots of questions. They don't have all the answers. I certainly don't have all the answers, but I do like to ask lots of questions. Well, why do we do that? I remember in 2007, we had paid this economist to come in, and we paid him a lot of money, and he came in, he was giving us his pitch because we were in the condo conversions. And I asked a simple question. I said, I got a question for you. In the last 10 years, do you have a list of all the predictions you made? Can I see your track record? He looked at me like I was crazy. He said, no, I don't have that. I said, why not? I'd like to know what your hit rate is, because you're telling us do X, Y, Z, and we're talking about making millions of dollars of bets on this. Well, how do we know how accurate you are? So.
You just hit two things on the head. Number one, the invert. I love how you just framed it, though. It's very different. We would look at our startups back 10 years ago, and we would try to tear them apart. How would we destroy it if we were our own competitors? Where are our weak points, et cetera? Love that. But I think about number two example of what you just shared was at NMHC this year when we were out there in I think it was in Vegas. They had the authors of Freakonomics spoke, and they were so humble to the point of like they were hired by a university, and the university's like, tell us the answer. He's like, we don't know, but we're going to ask a heck of a lot of questions. We're going to make a heck of a lot of mistakes. And I think to your point around flipping it sometimes to where you may not have all the answers, but you need to ask the right questions.
That's right.
Future of work, right? We're talking about robots, automation, AI, everything. How do you envision multifamily, the future of work, and the future of jobs the way they are performed today? Let's just say 3. And I know you're not into making predictions, but I know you have thoughts of that.
Yes. No, I do. I see it, like as I said, when I was watching that AI actually do the actual manual process of underwriting that deal and taking the information from the broker package and extracting it and putting it into the model. I think the middle side of this, the white-collar jobs, will be the first to be automated. I think the robotics will require the AI to actually build. Batteries are probably one of the biggest limitations, and I think the other big limitation is that we continue to try to force robots to look and move like humans because we're in a human environment. But the best robot structure for a roofer may not be a human structure. It may just be a rolling with little legs that can grab onto the actual tiles without damaging the tiles or something like that. So we have to remove that limitation from our minds. I think the future of work is going to be very, very different. I hear a lot of people saying, there's going to be a lot of new jobs created. Well, of course there will. But we don't know exactly what they are. And the other thing about that is, will those jobs require higher level thinking? I think it's something like, 15 to 20% of the population is involved in transportation, delivery. Well, what happens when we totally automate the entire delivery process? So door to door. So all your Amazon, all your Uber, all that stuff is totally done by robots and AI, just back and forth, everything. Drone dropping things off. What is that population? What are they going to be retrained to do? That's a huge number of people. Going to send them back to college to be coders? Well, AI does coding. So what are they going to do? Are they going to go be relationship experts to help old people? Maybe that's what they need to do. Maybe we need more nurses. But if you can build a robot that can take care of nursing and be there 24 hours a day and be a lot less expensive, it's going to be very hard. And also, who's paying for all this retraining and educational process? And the other thing I'll point out is the Luddite movement. So you guys are familiar with the Luddites, right? Okay. The Luddites, back when the weaving machines happened in London, they actually they went out and protested and broke up the machines, and they got their government. They were really upset because they were losing their jobs. Well, I can tell you right now, when these jobs start being replaced, you're going to see unions explode upwards. This is history. You're going to see it go up. You're going to see them get with the vote, and they're going to try to vote and tax the heck out of these companies doing this. Okay? And that's where the tax money is going to come for retraining and stuff like this. So these companies that are going to enjoy these huge margins, they're going to be taxed aggressively. And you're going to see terrorist attacks by these people losing their jobs. If you're a father and you have to feed your family and your whole career is wiped and you spent hours learning, went to college and learned all this stuff, like say you're an accountant and you spent your entire time, and now that entire profession is automated. By the way, way better. AI can do it 24 hours a day, never sleeps, never makes a mistake. What are they going to do? You're still going to need the accountant that talks to people and the salesperson. Those human skills are even better. But I see that, I'm saying, wow, what are they going to do? How are they going to retrain these people? But I do think the future is going to be very different. And when anybody can make an app I created apps. I have no clue how to code. I've created several apps using this new coding tool. That's incredible to me. And I did it in an afternoon. It should have taken me months to figure that out.
Incredible.
Yeah.
It's my kids are playing games to teach them to code.
Yeah. Yeah.
And we talk about the things that are interesting to us.
Yeah.
That speed up, save
Yeah.
time. Our kids now just expect that.
Yeah.
And I think the biggest one for me is that, and I was just having a discussion with someone here who owns a lot of real estate in Atlanta, and he said, "Could you imagine moving to Atlanta and not having a car?
Yeah.
Could you imagine, having drones delivered to your front door, packages? Could you imagine the police showing up first in a drone versus a police car?"
That's
so
right.
it's interesting because one of the areas that I've learned, and I'm curious to get your thoughts, is like sometimes you see AI right now helping in spaces that might not save you a lot of money or a lot of pain, but it seems like the jobs that are the most dangerous to do are the biggest opportunity, like the roofers, the window cleaners, etc.
Policing the communities.
Oh, policing
Yeah.
communities.
They already have like robot dogs.
Yeah.
Yeah.
We
Dogs.
saw them. Yeah,
Yeah.
They're here local.
So
yeah.
robot dogs. So the next thing is gonna be RoboCop. Like that's not far-fetched.
Yeah.
It's like it's coming.
I agree.
There's probably somebody working on it more than one person. Curious now, obviously you're buying, you're investing, and you're third-party managing, right?
That's right.
Now, how do you see in the advent of AI, all these discoveries and everything, do you see owners like you becoming interested in self-managing more, or do you see more of a movement towards like third-party, like more? Because I think what I've been seeing lately, at the top of the NMHC, like we're seeing consolidation a lot. The large companies are literally just buying entire companies, and they keep growing. So it's like a concentration of power right there in a number of units. But I wonder for someone like you, does it become more appealing to consider self-managing, or is that like a numbers thing? Do I need to get to like 10,000 or 20,000 units to make sense to take care of a house? Or you're like, no, I'm just gonna focus on what I do best, just investing and third-party managing everything in the context of the current AI situation and technology advancements?
Yeah, I've definitely been involved in the starting of two property management companies, one at Miles, obviously, and then we had third group properties, which I shut down. We had around 9,800 units, and we sold them all off. My take on this is it's definitely a very time-intensive process to set up a management company. It can be done. It can also be a profit center, yes. But I believe that most owners go through this cycle. And the cycle is they find a third party, and they deal with it, and they get frustrated, and they get to a certain critical mass. They say, we're going to bring it in-house. And they bring it in-house, and then they have the same complaints that they had about the third party, but now they're responsible. So you're looking in the mirror and say, well, I guess I suck too.
Let me get rid of it again.
Yeah, well, and then you go through this cycle. I think that the most critical roles are still the property manager, the maintenance supervisor, and the regional manager. Those are your critical roles. If you get a property with a great property manager, a great maintenance supervisor, and you have a great regional, your life as an owner is easy. If you get any one of those are bad, you're going to have lots of problems. And that spreads, it multiplies. So if you have multiple properties with bad property managers, or if you have bad regionals, it'll multiply. There are some management companies that are really good at all the processes and systems. But what I've noticed, the larger the companies in this consolidation, I see the silo effect. And I'll give you a great story of the silo effect. I once hired a CFO. He came, I'm not going to say the college. It was an Ivy League college. He was a CPA. He had all these credentials. And I brought him in. And I was like, okay, this guy, I didn't really test him a lot because I figured, he knows way more than me. I'm a high school dropout. He's going to run circles around me. I brought him in, and he was an absolute idiot when it came to the accounting. And I said, how can he has all these degrees? It's called silo rot. So they get into a particular field, and they only do that one thing. It was fixed asset accounting, and that's all he knew. That's all he did. He was expert at it. He ran circles around me on that. But the whole scope was much more. And because he didn't know everything, he was making stuff up, and he had forgotten a lot. So I see this, I call this the dead tree principle in our business. Basically, we learn a lot of stuff for 2 or 3 years, and then we stop growing. We stop going to conferences. We stop reading books. We stop taking courses, and then we're no better 10 years from now. And you see this again and again. You'll meet with these people that are high up, and they're no better. They haven't increased their skills at all. They haven't gotten any better. So seeing that, I always just scratch my head and say that's a waste because there's so much to learn.
I love that.
How about education, Ken? Right. I think the way the universities are being run, to my knowledge, I'm not like too involved with the education system, but just from what I could see from outside looking in, right? I think a degree today, that any type of, almost any type of degree that you would start as a young student, my son is going to college next year. The way it's being structured right now, the curriculum, probably by the time he graduates, or even before he graduates, it becomes obsolete. Most of the information that he's exposed to, it becomes obsolete. Are you in agreement with this thesis? Like, are you seeing something different? And then how can the education system adapt the classical, like, going to university to keep up with the space? Because, like you said, you sign up for the course and the next day you become obsolete, because, Claude was doing that. So the same thing happens in all the areas. It's not just like a isolated incident, a wow incident.
Yeah.
It's norm now.
Yeah, I believe that if you're a profession, a lawyer, an accountant, or doctor, obviously you have to go through college, and I think it's a good process. I also think the community building, I didn't go to college, I'm just saying from my looking back, but I think the community building, the relationship building, I think it's a very valuable experience for young people to go through. I've noticed a lot of people that I've hired straight out of college, they don't retain a lot of what they've learned. They've memorized to pass a test, and they sit down to actually do practical things, and they don't know. And you ask them, like, you took an accounting course. Yeah, I took 2 semesters, but they don't remember anything about accounting. They don't know the basics. Or I had an underwriter, and I was like, okay, well, IRR, you're a finance major. Tell me, walk me through it. What's XIRR, MIRR? What's the differences? And we got nothing, blank. But I do think that the college process of going through and taking those tests and learning those things is good for the young people to do. And I think the building and relationships, I think that's all an important part. I think a big piece of all this that's missing from most training, and this is another story that I've talked about a lot. I remember this very clearly. There was a huge leasing training. It was very expensive, and they came to me and they said, we want to send all these leasing agents to this leasing thing. So I said, okay, I'm very skeptical. Let's send them to it, but I want to test them afterwards and see what's going on. So we sent them off. They all came back, high five, and said, Ken, it was great. Thank you so much for sending us. We loved it. We had a great time. Show me the pictures and all that. I said, great. So I watched their leasing. For the first week or two, there was a little bump in leasing. I said, okay, well, maybe they learned something. Then I went back. I looked at it at 30 days and 60 days. They went right back to where they were. Behavior wasn't changed. So I think training without testing is worthless. You have to test. And you have to test constantly. And that's why when we read a book, for example, if we don't go back and test ourselves on what we've read, we won't remember it. So the testing is the biggest piece that's missing from a lot of the educational process. And I think in our own careers, if we go through a class, come back and test yourself. What did you actually return? And then come back later on and test to see what you retained. There's a forgetting curve. And we all forget stuff when we learn stuff. When you read a book, now, unless it's a great story, you'll remember a great story. Yeah.
Applications.
Yes, that's right.
That's what I think a lot about. I was in economics, and so much of it is math.
That's right.
And I'll never forget one of the courses was taught, and every single topic was a story. A lot of it was actually how criminals think. It was interesting.
Yeah.
And they dove into probabilities, examples from the story, and kind of kept you on your toes. I'm curious because, if you think about, I think one of the most important things in real estate is you're doing diligence. Like you said, you don't project the future, but you're writing on paper and making assumptions based on the previous owner, current owner, and you're making a lot of trust. How do you think about the partners you work with over the years? Why do you work with the partners who you work with, and what do you do if a partner is untrustworthy?
That's interesting. Well, I think that a partner is like a marriage. You better make sure that you are compatible with that person, that they are honest. And people change. Money changes people. Stress changes people. You see people's ethics when money's involved. I think that going through that process and looking at that, figuring out who your partner is going to be is probably just as important as who you're going to be married to if you're going to go into a business relationship. You can talk to other people, but I think it probably makes sense to do joint ventures and do a trial run and make sure that it fits and it works right, because you really won't know a person's personality until you go through a difficult time together. That's when you really know, is this person quality? And people change. I think I wrote a blog post about this. Performance, these A players, they're not always at A level. Let's say they're fighting with their spouse or their kid's sick. They're coming down. Or they're sick. They're coming down. And then you expect them to be a robot. They're not. People's performance fluctuates. Things change based on their life and their patterns. So I definitely see that, and I see this fluctuation even in A performers. There was a quote that someone said. They said, you should only hire A players. I'm like, well, that's great in theory, but if everybody's an A player, every A player I know wants to be at the top. They want to grow. They want to advance.
And they don't want to do everything. They want to do certain
Yes,
tasks.
yes.
And they don't enjoy like doing the busy work. Who's gonna do that?
Yes.
I've always found you find the people who are better than you at certain, so if you can, your point earlier about the silos.
Yeah.
You find the people, I tried to be, good at everything early in our career, and I said, wow, successful startups, successful companies generally have someone who's very good at one thing, and then find the person who's not good at other things.
Right.
Complementing.
Yeah,
Yeah.
complementing.
Yeah.
So, that's why, some people who are single founders can do great, but they find incredible people around them, and they're like, I'm horrible at this.
Yeah.
So I think same thing in real estate, right?
Yeah.
You hit earlier about great asset managers, great investors, may not be great operators.
Absolutely right. Yep.
Ken, we had a couple of other CEOs sitting in the same chair that you're sitting. And I asked this question. Do you think that electricians, plumbers, trade people, maintenance technicians, HVAC technicians are the millionaires of the future because of their jobs are not going to be like the first targeted by AI? Not to say that never, because you never say never, but chances are it's going to take a while for their jobs to disappear due to AI.
Here's what I would say. And the first thing is, if I could augment a groundsperson with an AI headset, with the glasses, and put them in front of an electrical panel, and the AI is highlighting exactly what to do, step by step. Wow. Think about that. That technology is available right now. So if you make it's supply and demand, the millionaires, okay, that requires supply and demand imbalance. So we know like AI guys right now, they make gazillion dollars because there's only a handful of them or whatever. So in order for your hypothesis to be correct, we would need to have a major in supply. Now what you've got is you've got a lot of the boomers are retiring, and so you're going to see this shift. We have a shortfall. However, when there's huge margins to be made, what are the robotics companies going to be? What are the augmented people going to be? So I could see a future where you augment people who have not been trained. They can be apprentices under a master electrician, and they have these goggles on, and it brings down the cost because they're a fraction of the cost while they're training.
So interesting. What you just said is similar to what Mark Andreessen just said, whether you agree with him or not at A16Z, and he said theoretically AI can bring down the cost of not everything, but can bring down the cost of a lot of things that are very expensive or out of the reach of many people, because it will, in some areas he's like, could you imagine, right now with AI, you're getting tens of thousands of searches for like a penny.
Yeah.
Right. And so that has become really, and it's extremely competitive in being offset. But yeah, that's the question of what happens in jobs. Does pay come down in certain sectors, but other sectors skyrockets?
Yeah.
And it's the hard part because there's always a delay between that training.
That's right.
We talk about that a lot, like the need for certain types. I'd ask you, what's the biggest opportunity right now that maybe other people are overlooking in real estate? What's a sector or something that people should be paying more attention to as an asset class or an opportunity, or spending their time on?
Well, you know what I'm going to say with this. It's probably going to be AI. I think that AI has the potential to transform how we do business. I think AI can automate entire workflows in the office. I think it can reduce payroll. I think it can increase revenue. I could see AI actually minimizing the mistakes. For example, rent roll. How many times have you gone to a site, pulled up a rent roll, and found they've double charged somebody? Or they're missing all these, why don't everybody have pet fees? Or we're supposed to have water on everybody, or everybody's supposed to be charged insurance, and they're not. Well, unless you're auditing it and looking line by line at all that, few people are, then how do you know? So AI could immediately do that and pull that out and flag things. AI could also compliance monitor to make sure there's no errors in the system. So I think there's a lot of waste in the entire process from start to finish in all the functions, whether it be work orders, whether it be turning units, whether it be leasing or renewals or customer service interactions, all that. I think AI is going to have a tremendous impact on every bit of that. And the companies that figure that out, of course, they're going to be the biggest winners. And you saw, I think it was RealPage just came out with their new AI agents recently. They have 5 different ones. And I think this trend's only going to accelerate. And I think these opportunities, you're going to have the companies that use it, and you're going to have the people that don't, and you're going to eventually see this differential show up in the financial statements, which of course leads to the cap rate differential. So if I'm an owner and my management company is not using that technology and it's costing me money, I'm firing that company to bring those companies on. So I see that definitely. And that, by the way, these aren't necessarily predictions. These are just supply and demand and cost constraints. So I'm looking into the future saying, wow, I see what it can do now. And I'm saying, okay, next year or the year after that, what will it be like and what will happen? And that's where I'm going with that.
I know what we have to buy you.
What's that?
But we have to get you a custom-made hat that's called the Predictor.
No.
So
I don't predict. No, I have no clue. Just call me the clueless would be better.
Clueless, that's a good one. All right, I love how humble you are, but I think that you're so dedicated to the craft,
Yeah.
and you have so much experience and solid experience. Now, who? I'd love to hear from you. You can feel free to name names here.
Mm-hmm.
Who's someone that's maybe stood out in your career that helped you and made a big impact on you? Number one. Number two, maybe it's someone who you would love to work with or partner with that you really admire.
Wow, that's interesting. Well, obviously, my current partner, Christian Shields, he's taught me to be much more thoughtful in my responses and thinking. He's a lawyer. And I worked with Daniel Molina, who was also a lawyer, and both of them, having two lawyers on the team at the time, was an incredible experience because I got to see the two of them go back and forth and how they approach things. So I have a lot of respect for lawyers and how they approach and how they think things through. That's been very good. There are so many wonderful operators. Norm is incredible. I've met him once. So there's a lot of great people out there in the space. Obviously, when I got into the business, Daniel Miles. I learned a lot from Daniel Miles as well. They've all contributed in some way to helping me get better and learn. But I would say the biggest thing are books. Books, to me, are the biggest factor that's really, whatever problem approaches me, and now it's AI, because now with the AI tutoring, you can pull it right up, and it can tutor you on things. And it's amazing. So I actually created a Charlie Munger bot that actually throws Charlie Munger problems at me, and I have to analyze the problem as if I'm Charlie Munger.
Smart, yeah.
So this type of learning and training to teach your mind to do that, I think critical thinking in the future is going to be very important, and teaching people to think critically, like underwriters or property managers. Like, well, why do we do that? Asking these questions, because everybody thinks they need to have the answer. I'm saying, let's get the question, guys. The question's more important. Voltaire said this: don't judge a man by his answers, but judge him by his questions. And I think that's such a profound thought. What questions are you asking? What questions didn't you ask that you should have asked?
Ken, super amazing to have you here in the studio. Very much appreciate your time and your generosity with it. Looking forward to a next one very soon.
Thanks a lot. I appreciate it. Enjoyed it.
And before you go, what is one thing we can help you with to make this a spectacular year for you?
That's an interesting thing, because you have to say, like, in what area of your life, right? So you have to break the components down.
Sure.
So you have your health, you have your family, you have your career. So we're assuming it's something in the career bracket.
I'd actually ask you. I actually love the personal side more.
Yeah.
Health, personal life. Yeah.
Yeah. So I was telling. Okay. So a couple of things that happened to me early on. So one was my introduction to Stoicism, because if you focus on just what you can control, then it makes your life so much easier. Sometimes we look at things that we have no control over and we get upset about them, but we can't have any control. So why are we getting upset about it? So Stoicism was really impactful to me. The other thing was minimalism. So minimalism, what it taught me was you don't need all this stuff. So when I started becoming wealthy, I went out and had the 11,000 square foot house. We had the S500 Mercedes. We had all the, I had $20,000 suits, all the craziness. And you realize you don't need all that stuff to be happy. You're buying that stuff because you're supposed to, but that's not what's going to make you happy. It's your relationships that make you happy. And the first wealth is health. As I get older, I see people getting sick, and they're sacrificing their health when they should be focused on their health. Your health is your number one priority. It has to be on your calendar. It has to be the very first thing, because if you're not healthy, how are you going to take care of your family? How are you going to take care of your friends? So health is the first thing that I look at. But no, the thinking process, and constantly revising my thinking process. So for me, I know that most people are about as happy as they make up their minds to be. They're not necessarily, you could win the lottery. Like, they've done these studies. People win the lottery and they're really happy, and then after a while, whatever their baseline is. And they've done this too. People that have been in tragic car wrecks and lose their legs, their baseline happiness, wherever it was. So you're about as happy as you make up your mind to be, typically.
Love
Interesting.
that.
Yeah.
I think about that all the time. We talk about what you actually need versus what you have.
Yeah.
And having perspective in life. So trying to be a better dad in that way.
There you go.
So,
yeah.
we actually have to tie it up because I got to get home to my kids.
Yeah, no problem. All right, awesome. Yeah, enjoyed it.